Please, you need to go on the working capital management. Try as much as possible to practice as many questions as possible. There are several question and answers in your Pathfinder, in your ICAN Pathfinder. So endeavor to ensure that you practice as many questions as possible. For those of you that have the golden book, I have about 15 different question and answers there. So make sure you practice all of them. Make sure you practice all of them because you don't know. Like I said, you don't know the kind of scenario that examiner will test on that day. All right. So, and that's why it is good for you to, it's important that you go all out. You expose yourself to several questions and answers so that you'll be able to come out in flying colors on the day of your exam or when your result is released. Now, let's talk about business valuation. I will do my best to ensure that we complete this topic within the next 2 periods, okay? Within the next 2 periods. It's a very big one, but again, at this level, ICAN cannot give you the kind of question you are going to see on the day of your exam will be a simple one. It may be, it's at this level, it will be more of a theoretical kind of question. But again, you never can tell. But if at all examiner is going to test any calculation, it will be very simple and a straightforward question. All right. Okay, let's talk about valuation. What do you mean by valuation? Let's say, for example, we have company A. We also have company B. The two companies, they want to merge together to become company C. This is what we call merger. All right. When two companies, two different entities come together to become combined business, then it is called merger. All right. So when in the merger transaction, the two of them, for example, A and B are coming together to become C or to become AB. Now, A will need to value itself as of today, before we become C, as of today, what is my value? B will also need to value itself. At the end of the day, you then determine the value of C. The value of C will be value after the business combination, after A and B has merged together to become C. So that is one reason for valuation. It may also be that a company may want to acquire controlling interest in another entity. So when that happens, you need to value the business. Now, what do you then understand by valuation? Valuation represents the process of determining the economic worth of a business or of a company's share. You want to determine the economic worth of a business. What is the value of a business? Okay? Or it may well be that you just want to determine the equity value of the business. So whatever the case may be, valuation is carried out for different purposes, including one, you can carry out valuation for the purpose of merger and acquisition. Okay, so in the merger and acquisition transaction, of course, when it has to do with merger, only the two individual businesses that are merging together will need to value themselves. In my example, in this case, company A will value itself, company B will also value itself. So to know the worth of individual businesses. So when you do that, you are simply calculating the pre-merger market value of A and B. You then need to calculate the post-merger market value. What is the value after the business combination? After they merge together, what is the value of the combined businesses? That is the post-acquisition market value. All right. You can also carry out valuation for the purpose of acquisition. Okay, for the purpose of acquisition. Acquisition arises when a company acquires controlling interest in another entity. Okay, when a company acquires over 50% in interest in another entity, we said the company achieve controlling interest. That is acquisition or takeover. So in the takeover, only the acquiring entity will carry out the valuation. The company that you want to take over, the company that you want to acquire will not do anything. It is the company that wants to acquire the entity that will carry out the valuation. Okay, so that is that. The second one is for estate and tax purposes. You carry out valuation for estate and tax purposes. For example, when somebody dies and the person leaves an estate, okay, maybe you have property in several places and all of that. So the person died with different estates. So the beneficiaries, you want to determine, you may want to value the estate to be able to know how much, what is the worth of the estate, so that you know how much will be attributable to each beneficiary. Not only that, when you value the business, you may want to determine how much tax that will be payable from the estate. Okay, so that's also one of the reasons for valuation. In fact, at this level, the reasons or purpose for valuation is highly examinable. So please, you need to ensure you master that. Then the next one will be shareholders or partnership dispute. When you value a business, when there is shareholders or partnership dispute, for example, if the owners of the business have misunderstanding and unresolved misunderstanding, there may be need to wind up the company. You may want to close down the company so that I'll be able to know, as a shareholder, I want to know how much should be attributable to me after the closure of the business. Okay, you dispose of, you value the business so that we can sell it, and then I will know how much that will come to me as a shareholder. The same thing in partnership business. When there are misunderstanding between or among the partners, so you need to dissolve the partnership business and determine the value of the business so that we know how much should be attributable to each partners. All right, so that is for shareholders and partnership dispute. The next one, number 4, you also carry out valuation for the purpose of marital dissolution. All right, this is not common in Africa. Between the two partners, it is possible, between the spouse, any one of the party that has a higher assets, okay, any one of either the husband or the wife, any of them that have the higher assets, then will be the one to settle the other one. Before that settlement, because it is the court that will do the judgment. So you need to determine the value before the court will pronounce that, okay, this is how much the other party that should be paid to the other party from the estates of any of the partners. Then you need to know what is the worth, what is the value of the estates. For example, like I said, this is not common in Africa. I've never heard anyone in Africa that when they dissolve their marriage, then you now settle the other party from the asset or from the estate of the other party. But this is very common in the Western world. All right, like for example, all these VIPs, like Bill Gates has done it before. Jeff Bezos also did it. Okay, even Elon Musk, all those big guys, all those big guys, they've done it in the past, whereby when they dissolve their marriage, and then of course the court pronounced that, okay, so much should be paid to the other party. All right. So this is very common in Europe and America, but not in Africa. Africans, you go die there. Africa no go gree. Okay, yeah. So the next one is loan facility. Depending on the size of the loan, if you want to borrow a loan from a bank and then the loan amount is significant, then your bank or your lender may want to know what is the worth of your business as of today. You say you need 1 billion naira loan. Your business, what is the worth of your business? I want to know. All right. So if I know the worth of your business as determined by an external party or external valuers, so then if I see versus the loan that you want to borrow. I can determine whether I should lend you the money or the loan facility or not. Okay, so that's also one of the reasons for valuation. So in this case, let's say, for example, now, company XYZ PSC needs a loan of 5 billion naira, and the company approaches a bank, and the bank is requesting for, go and show me your valuation report. So company XYZ, we need to make an arrangement. We need to hire a consultant or a valuer that will determine the worth of the business for the purpose of the loan facility. All right. Then number 6 is liquidation. When a going concern of the business has been brought to an end, then when you want to liquidate a company, you need to determine the value of the assets. As of today, if you want to dispose these assets at a break-off basis, then what is the worth of the asset? What is the value of the asset? So that we'll be able to determine how much the company will be asking for when disposing of the assets. Then the next one is litigation. Okay, the next one is litigation. All right, litigation will arise as a result of disputes between parties, between two or more different parties. Litigation can arise between a company and contractor, or between principal and the agents. So when there is an unresolved dispute between the two parties, then there may be litigation. When there is litigation, the court may decide that, okay, we need to value the business so that we'll be able to, or the asset in dispute, whether the business or the asset in dispute. So we need to value it for the purpose of determining how much claim will go to either party. All right. So that is for litigation. The next one, or the last one on the list, is for stock exchange listing. When the company wants to go for initial public offering, right? You want to go a limited liability company wants to go for initial public offering, then you need to determine the worth before you go to public. Before you go for stock exchange listing, you need to determine the worth. What is the value of the business? All right. Okay, so these are some of the reasons for carrying out valuation. Please, like I said, these are examinable, especially at this level under financial management. Ensure you understand it, and in case you are asked, it will be a bonus. If you don't, no matter how cheap is the question, if you don't know, you don't know. There's nothing you can do about it. But I will encourage you, ensure you master all of them. If you have, you see the details. You see the detail, all this that I'm explaining, you see the details if you have the material where you can read more on each item that you have there. Now, before we talk about method of valuation, there's one more important area of valuation that's even ICAN also included in the scope of business valuation, which is requirements for valuation. So let's talk about requirements for valuation. Then we come back to method of valuation. Let me stop sharing this so that I can use that one to explain. I can use the workbook to explain the requirement for valuation. Okay. All right. So what are the key requirements for valuation of a business? When you want to carry out valuation of a business, what are the things you need to put in place? Let me put it down. Key requirements for valuation. You know, on the day of the examiner will just give to you some information about the company and the proposed valuation. So those information are gotten from somewhere. All right. But before you begin the valuation, the main valuation, what are those things you need to put in place? What are the basic requirements for carrying out valuation? The first thing that you're going to consider when you want to carry out valuation will be for you to define. You need to know what is the purpose of the valuation. Why are you carrying out the valuation? So number one is to define. You need to define the purpose. The purpose or reasons for the valuation. So like I explained to you earlier, there are different reasons for valuation. You can carry out valuation for the purpose of merger and acquisition. Okay, merger and acquisition. You can carry out valuation for tax purposes, for estates and tax purposes. You can carry out valuation for stock exchange listing. Okay. You can carry out valuation for loan facility for the purpose of loan facility. So etc. So these are, you need to define when you want to carry out valuation, you need to ask from your clients, why are you carrying out, why do you want to value, why do you want to carry out valuation? So your client may say, okay, we want to acquire another entity, or we want to merge with another entity. It may be that, okay, we have issue with tax authority, and then we need to determine the value of the asset or the business in general, whatever the case may be. So there will be, you just have to define the purpose of the valuation. That's the first requirement. That's the first requirement. The second key requirement for valuation would be to obtain accurate and complete financial information. Okay, you need to obtain, let me put it down for you. Obtain accurate and complete financial information. What kind of information are you looking for? Of course, we talk about financial information. This will mean you need to get the audited financial statement of the company. Okay? You need to get the audited financial statement of the company. Okay. The audited financial statement will include the statement of profit or loss accounts, mainly for the purpose of the valuation. So you need the statements of profits or loss accounts. Then you need the statement of financial position. Okay. Not only that, you also need statement of cash flow or cash flow statements. Then, of course, statement of changes in equity. But again, the main one is the notes to the accounts. In the notes to the accounts, you'll be able to see the actual tax paid. All right, you see the actual tax paid, you see the information on the depreciation, amortization, and all of that. So these are the audited financials. Once you see audited financial statement, then it shows that the financial information to a large extent is reliable and credible. Why? Because it has been audited and opinion has been expressed on the financial statement. And that's why it is audited. It's an audited financial statement. It's a public information. If the company is already listed, if the company is already listed on the stock exchange, when you go to the website of the company, you'll be able to see the audited financial statement for several periods. It could be for 3 years or 4 years or 5 years or whatever the years that you need the information for. For example, if I want to value Guaranteed Trust Bank, GTB, for example, all I need to do, first thing first, I will just go to the website of GTB. You will see investors information, all right, or investors reports. From there, I can pull up the audited financial statement. From the financial statement, I'll be able to see. I'll just go to statement of profit or loss. I will see the revenue for the period under consideration, maybe for the past 3 years. I will see the information on revenue. I will see information on operating costs or operating expenses. I will see tax. I will see depreciation. I will see all sorts of whatever the information I'm looking for. I will see it from the audited financial statement. Audited financial statement. So those are that is how you are going to get the accurate and the complete financial information. Then number 3, you also need to, now the next requirement is to identify the valuation subject and scope. Okay, you need to identify, let me put it down, identify the valuation subjects and scope. Okay, what are the scope of your valuation? It may well be that the scope could be, let me put it down for you. The scope of valuation could be for 1, the entire company. You may want to value the entire company. You may want to value the entire company. Okay. It may well be that the scope is for a division. Let me put it this way. Entire company, this represents the corporate, that means you want to determine the corporate value or enterprise value. So it may be for a division of the business or a subsidiary, whatever the case may be. It may well be that your valuation, the scope of the valuation will be for a specific asset of the business, or it may be for a project, the company's project that you want to carry the valuation on. So basically, you must identify the valuation scope, so that the larger the scope, of course, the larger the valuation fee that the company will pay to you as a consultant or as a valuer. Then number 4, because if you are valuing an entire business, God help you, maybe it's a business that have operation in several locations. So a high level of effort will be required for the purpose of carrying out the valuation. Because again, the bigger the size of the company, the longer it will be for the valuation to be done, because you are going to need so much information at your disposal. And at the end of the day, more effort will be needed to carry out the valuation, like a company that is relatively, not too big, just a small company for that matter. So little effort will be needed. Then number 4 would then be to, now that you have understand the scope of the valuation, there is the scope of the valuation, then you also need to develop cash flow projection. Okay, you need to develop. Now, from this cash flow, let me put it down first. Develop cash flow or financial projection. Now, this cash flow projection, you can get it from step 2, from your audited financial statement. Like I said the other time, your cash flow projection you can get it from your audited financial statement. All right, you are going to see if, for example, in 2024, the company makes sales of about 10 billion naira, makes sales of about 10 billion naira. So you need to make a projection. You are using your past information to project the future, because you cannot use the figures you have in the financial statement to project for the future. I mean, to determine the future value of the business. So you need to make an estimate. You need to develop an estimate of your future cash flows. So let's say, for example, the company makes sales of 10 billion naira in 2024. Then, in this case, you need to make an assumption to check the trend within the last 3 years, within the past 3 years. What is the growth rate in sales? How much sales was made in 2022? How much sales was made in 2024 and then in 2023 and 2024? So you'll be able to see the trend. Then from the trend, you'll be able to determine the growth rate that will happen, that will affect the future cash flows. All right. Because at this level, this number 4 requirement, you want to make a projection for the future, maybe for the next 3 years. You want to determine the value of the company for the next 3 years or for the next 5 years at a minimum. All right. So like I said, so you then determine the future projection, the financial projection. So like I said, this cash flow would be for at a minimum, maybe 3 to 5 years. All right. So you can determine 3 to 5 years financial projection. Financial projection in revenue, operating costs, and the likes. Okay, then number 5, the 5th requirement, cash flows. The projected the forecast, the cash flow forecast. You have determined the cash flow forecast. The next thing you are going to do is to estimate appropriate discount rates. Okay, you need to estimate, or you estimate or determine. You estimate or determine appropriate discount rates. Discount rate or cost of capital. All right. So, of course, what are the components of your cost of capital? When you are calculating the WACC, first thing first, you need to calculate cost of equity. Okay, you need to calculate cost of equity. When you are calculating the cost of equity, right? When you are calculating the cost of equity, you need to use capping, capital asset pricing model. So in your capital asset pricing model, we said capping is equal to the risk-free. You are going to need to calculate your capping. You are going to need the risk-free rate of return. Okay, you need the risk-free rate of return plus the beta value, then plus the market risk premium. You are also going to have market risk premium. Let me just let me write it out in full. Risk-free rates of return. All right. Then you have beta. You are going to need beta factor. Remember, you use beta to measure risk. Then not only that, you also need to consider market risk premium. Market risk premium, which is the difference between market return and the risk-free rate of return. Not only that, you also need to consider, you need to add the country risk. You need to add the country risk. What do you mean by country risk? Country risk is the totality of risk that are present in a country that may affect investment of a company. All right. So let me put it down for you just in case. Notes, country risk, represents the potential risk. The potential risk in a country or within a country. Potential risk within a country that can affect investments of a company, that can affect the investment of a company. Examples, what are the examples of country risk? Examples of country risk include: one, we can have political risk. Two, you can have economic risk. Three, you can have legal and regulatory. Risk. Okay. So what do you mean by political risk? If there's political instability within a country, or when there's a change in government, this can arise as a result of change in government, or change of government rather. When there's a change of government, then you can have political risk. It can result to political risk. It is also possible there may be political unrest or political instability. So when there's political instability, it will result to political risk. Then what do you mean by economic risk? The economic risk can result from inflation. Okay, inflation risk is one of the examples of economic risk. You can also have currency risk. You can have currency risk, inflation risk. So all these are examples of economic risk. Okay, then the other one, which is regulatory risk, there could be tax legislation. This one can happen as a result of new tax legislation, like what we currently have in Nigeria by effective January 2026. The new tax reform will take effect. All right. So that is a legal or regulatory risk. Not only that, currently in Nigeria, sometime last year, I think February 2024, the Apex Bank, the CBN, rolled out a new capitalization threshold for banks, which means that all the banks in Nigeria should recapitalize with a specific threshold, depending on the size of the bank. So this is what is known as regulatory risk, which means that any company that does not operate in the banking industry will not be affected with the regulation. All right. So these are some of the examples of country risk. I don't know at this level. I don't know if the examiner can be asking you that, but again, it's good to know. All right. Then, so I told you when you are calculating cost of equity, you use capping. In using capping, you also need to consider the risk-free rate of return and all the risk that will affect the business, because your cost of equity or your cost of capital must be consistent with the total risk associated with the business or with the company. all the total risk, both systematic and the unsystematic risk that will affect the business. So you need to consider it. Then after cost of equity, you also need to consider cost of debt. Okay, you consider cost of debt. Let me see. What did I use? See asterisk or arrow for cost of equity? Yes. So the next one is you need to determine post-tax cost of debt. So you determine post-tax cost of debt. That's the KD. So your KD in this case may be calculated as interest multiplied by 1 minus tax. All right. Or it may well be that you need to calculate if it depends if your debt relates to bond or relates to if it's a traded debt like bond, like debenture or loan notes, then you need to calculate the cost of debt the same way we normally calculate it under cost of capital. Okay. So whatever the case may be, you calculate the cost of debt, then finally you calculate WACC to get your cost of capital. You calculate WACC, take into consideration the gearing ratio of the company. All right. So equity over equity plus debt multiplied by cost of equity, then plus debt over equity plus debt multiplied by after tax cost of debt. You know the formula for calculating WACC. All right. So this is how you are going to estimate. Like I said, this WACC that you want to calculate must be consistent with the risk associated with the company. All right. So that's basically the appropriate discount rate that you want to calculate. The cost of capital must be appropriate and consistent with the risk associated with the company. Okay. Now, after this, the next requirements for valuation would then be to select suitable valuation method, right? You know, earlier, okay, we have not even talked about valuation method. In any case, number 6 requirement. The sixth requirement, number 6, is to determine the valuation. You select suitable valuation method. Select suitable. After you have estimated the cost of capital that you want to use, then you need to select suitable valuation method. There are several methods of valuation. You can use asset-based approach. Okay, you can use asset-based approach. If you don't use asset-based approach, you can use income-based approach. Or you use the discounted cash flow. You use the discounted cash flow based approach. Discounted based, the discounted cash flow based. Approach. Of course, you have to use more than one valuation method. You have to use more than one valuation method. In practice, when you are carrying out valuation of a business, you need to use more than one valuation method, and you provide the range of value to your client. All right. So you can use the discounted cash flow method in conjunction with the asset-based approach or price-earning ratio, whichever one that you want to use. All right. Or you want to use enterprise value or enterprise multiples. Okay. So whatever the valuation method you want to use. So That's one of the requirements for valuation. Then the next one. Now, like I said, when you are carrying out a valuation, there will be two stages of your valuation: the initial period and then the terminal value, the initial period and the period after the initial period. So the initial period may be for 2 to 3 years. That's the initial period. So you are going to calculate the market value or the present value for that initial period. Then after that, you need to calculate the market value for the terminal value. The terminal value is the value of the business after the initial period. So if the initial period is for 3 years, then after 3 years is 4 years. So you need to calculate the value of the business from 4 years to infinity, because it is assumed that the company will continue in operation for the foreseeable future. Okay, the company will continue in operation for the foreseeable future. Therefore, you are not just valuing the business for the initial period, you also need to determine the market value after the initial period to infinity, which is your terminal value in this case. So step 7 says you should obtain terminal value and growth rates. All right. So I will come here, obtain terminal value and growth rates. Now, if you're an external consultant or external valuer, you need to relate with the company and agree on what will be the terminal value. In this case, you need to establish what will be the growth rates after the initial period. When you look at the trend of the company's cash flows, to a large extent, you may be able to, and then you also need to consider the inflation risk or the GDP in a country to say, okay, if the inflation rate is this percentage or the GDP is this percentage, how much do we think will be the growth rate for the foreseeable future? It may be 2%, between 2 and 5% is okay. All right, the growth rate for the to infinity, or from initial period to infinity, may be between 2% and 5%. So you can't have so much. If it is higher than that, then it will become unrealistic. All right, because you have to be kind of a conservative. All right. Then the next one. So the number 8 item that you need to consider, the requirement you need to consider for valuation would then be to, it's not just about calculations alone, okay? Your valuation is not just about figures or calculation. You also need to consider the qualitative factors. You need to consider or establish qualitative factors. Qualitative. So what do you mean by qualitative factors? Under this, you need to know the quality of the management of the company. What are the quality of the management team? Quality of management. That's it. You want to know the management structure. What are the kind of individual, their experience, their exposure, their qualification, and all of that. So that will determine the quality of the management. Then not only that, the company rating. You also need to consider the company rating. Company rating as provided by, if any, as provided by the rating organization like S&P, okay, S&P 500, like Fitch. These are notable rating companies, international rating companies. We also have Augustus in Nigeria. So that's local rating organization. All right. Because this rating has a lot to do with your credit worthiness as a company. Okay. Not only that, another qualitative factors you need to consider is the corporate governance system within the company. So what are the corporates? Show me the governance system. What are the governance system within the organization? All right. So if the governance is tight, Of course, that will also give some level of credence, credence to the valuation, the quality of the valuation report. Okay, so these are some of the qualitative. There are so many qualitative factors that you need to carry out. Not only that, you also need to consider in your qualitative factor. You need to consider the customer loyalty, the brand, the company's brand. Okay, so uh, then of course the competitive position of the business, the competitive position, all right, within the industry. So these are some of there are a lot of qualitative factors that you can put in, but these are just some of them to keep it simple. Then number 9. Now, after your calculation and after everything, then you need to carry out a kind of sensitivity analysis or scenario analysis. This is very important in order to give credence to your valuation report, all right? Because you are demonstrating that what if this happened, if this event happened, what will happen, what will be the value at the end of the day? So when you carry out valuation, when you carry out, let me put it down, when you carry out scenario analysis, to carry out scenario sensitivity analysis first, sensitivity or scenario analysis. Okay, especially relating to, so you can carry out sensitivity analysis relating to, let me write it, doesn't look like relating. Okay, relating to, for example, tax. You may want to know what is the sensitivity margin of tax liability. How would the change in tax liability affect the market value of the company? Okay. Again, sensitivity in cash flow. Your cash flow estimates. How will it affect the value of the business? You can talk about, you can do sensitivity to cost of capital or discount rates. So if the cost of capital increase by a specific percentage, what will happen? What will be the impact on the value of the business? So these are some of the areas in which you can carry out scenario analysis or sensitivity analysis. Okay. Then the last one, the last requirement for valuation would be to present the valuation report. The last one is to present the valuation report. Presents valuation report. So in doing this, when you are presenting your valuation reports, of course, is an expert. You are an expert in this regard. Therefore, first thing first, you need to develop executive summary. Okay, you need to have executive summary talking about the background of the valuation and all of that, the engagements, the engagement of your firm for the valuation and all of that. So you have a kind of executive summary in your report. Also, in this valuation reports, you are going to have the methodology that you have used. You need to indicate the methodology, okay, that you have used, then the calculations that you have done for the valuation. This usually will come as an appendix. This will come as an appendix, okay, because you cannot put the entire calculation, your valuation, everything. You can't put it in your valuation report and in the main report. Your report could be like maximum maybe a page or maximum of 2 pages. That's your report. But all those all the documents that you have used for the purpose of the valuation, that you have solved or you have retrieved information, all those things you need to attach it to the report. All right. So of course, the main calculation will be as an appendix. Okay. So these are just some of the things that will be included in your valuation report. Of course, it's more than this, just as a high level. All right. So these are the major requirements. These are the main requirements or key requirements for valuation. Again, like I said, at this level, examiner can ask you what are the main requirements for valuation or what are the requirements for valuation. So you should be able to talk about all of this. You should be able to talk, you just have to list them. All right, just have to list them. So again, I'm not the examiner. Nobody, no lecturer in ICAN, lecturer of ICAN tuition that will tell you that, okay, this is where examiner will test these diets on financial management, because this is the first outing. Financial management is the sexy is the sexy subject in ICAN for these diets. You know, the new prince. Okay, is the latest prince in town. So, or latest bride in town. So nobody can predict with certainty that these are the areas that examiner will test. So, but again, that's what I said, that I advise you just have to go all out. Don't restrict yourself to what you have done in the class alone, because there is no how you can cover A to Z of the syllabus in the class. There will be some scope of the syllabus that may not be touched because of time factor. And that's why you have the responsibility to ensure that you go all out. Seek for materials that are valuable materials where you can get those, you can read more about the each topic. Not only that, as you are also reading, you also need to use your ICAN study pack. Okay, you need to use your ICAN study pack in conjunction with the other valuable material that you have, like Golden Book. Okay, financial management or strategic financial management Golden Book by Adejuwon Daud. So all those information that you have there, topic by topic, do well to ensure that you battle them, you use them judiciously. Then once you are done, then begin to solve Pathfinder question and answer. Pathfinder question and answer is meant for you. You have the rest. You can't be going to exam hall without you testing Pathfinder question and answers. You need to practice it to get ready for the D-Day. Okay, then. Now, finally, let's talk about methods of valuation, even though I've mentioned this under the valuation requirements. So, but basically, let's talk about methods of valuation. Let me switch so that it will be faster. I would like us to solve at least, if not one question, if not two, that we should be able to solve one question today. So let me switch to the study material so that we can use it to explain the valuation method. Now, what are the methods of valuation? So there are several methods of valuation, but the most common one are grouped into three. The most common one are grouped into three. One is asset-based approach. One is asset-based approach. The asset-based approach is a method of valuation. The value of a business using asset-based approach represents its net assets. Okay? When you want to value a business using asset-based approach, what you are simply doing is to determine the net assets of the business. Okay, to calculate the net assets. And the net assets represent the difference between the tangible assets, and then the total liability. Different, let me put it down. Of course, I think you have it in this material. Let me see. Yes. Let me see. Blah blah blah. Evaluation is made using the value of a business is calculated as total assets. It's not just total assets, it's total tangible assets minus total liability. Okay, what we are saying is that the value of a business using asset-based approach represents its net assets, and the net asset is total tangible assets, total tangible assets minus total liability So this means that any intangible assets arising from goodwill, copyrights, patent rights should be ignored when calculating the net assets. So what we are saying is that when you want to value a business using asset-based approach, all right, you need to simply calculate the net assets. And we said that net assets represent the total tangible assets minus total liability. So which means that if you are given intangible asset like goodwill, when you are given intangible asset like goodwill, all right, the copyrights, okay, copyright or patent rights, all these intangible assets should be ignored except they have a market value. It is only when you are given the market value of the goodwill or market value of the copyright or patent right, then you need to include it as part of your assets. So, but if you are not given the market value of the assets, of the tangible asset, then you need to ignore it. Okay, so now, there are four different components of asset-based approach. There are four different components. We have book value basis, we have replacement basis, you have a realizable value basis, and we also have a breakup basis, realizable value or breakup basis. Now, of course, you can read all of them are the same. The only thing is that for the book value basis, the book value, of course, represents the figure, the value you have in the balance sheet. All the value you have in the balance sheet represent the book value. So when you are using balance sheet figure to determine your net assets, that means you are using the book value basis. However, if examiner wants you to use the replacement value, that means you are going to change the replacement value, realizable value, the breakup value basis. So you are going to change the figure you have in the balance sheet with the figures given to you under each of them. All right, that's what you need to do. It is the same net asset you are going to compute. It's the same net asset. So you can just read more in all of this to know more what is realizable value, what is the breakup basis value. So read it in this material because of time. So examiner cannot be asking you what is breakup basis, what is no. Examiner will only ask you to value using the liquidation value basis. So what we are saying in essence is that when you want to value a business using the realizable value, replacement value basis, or liquidation basis, you are going to change the figure you have in the balance sheet. You change it with the value given to you under each of the replacement value, realizable value, and then breakup value. So whatever you have there, you see. Then when we have a live question, you will see what I'm talking about. But for now, let's keep it as it is. Now, so that is basically the asset-based approach. So if you now want to determine value per share, under asset-based approach, if you want to determine value per share, it will be the net assets. Okay, it will be net assets divided by number of ordinary shares. It will be net asset over number of ordinary shares. That will give you the value per share. Okay, so let's move to income-based approach. The income-based approach can be grouped into three. There are three different components of income-based approach. We can have price-earning ratio basis, you can have dividend yield basis, you can have earnings yield basis. Okay, that is under the income-based approach. dividend yield basis, and then earnings yield basis. When you talk about price earning ratio, for some of you, you might have done financial statement analysis. For those of you that are doing financial reporting, all right, Mr. Wasu might have taught you financial statement analysis. Even Mr. Shiwaju, I think under um, divisional performance evaluation. So you have some ratio there, but not in details. It's possible. Mr. Ashwaju too must have touched one of the areas in the in ratio, but that's not the discussion for today. Right? So under the income-based approach, like I said, you can use price earning ratio. Price earning ratio is computed as the ratio of share price, to earnings per share. Okay, this will give you price earning ratio. Now, when you now want to value a business, this share price, this numerator, which is share price, is the value per share. So if you now want to value a company using price earning ratio, all you need to do is to just cross multiply. Therefore, the value of the business will then be equal to price earning ratio multiplied by earnings per share. This will give a value per share. So if you want to determine total value, it will be price earning ratio multiplied by earnings. But the challenge with, this method is that it will not be as straightforward as it is because earnings per share relies heavily on accounting profits, and the accounting profit can be distorted. Therefore, you need to make some kind of adjustments to your earnings before you determine the value of the business. However, so when you are using price earning ratio to value a business, of course, the PE ratio is suitable to value a company that have a profitable history. All right, any company that has a profitable history can use price earning ratio for the purpose of valuation, which means that any loss-making company, a company that is making loss, cannot use price earning ratio for the purpose of valuation. Not only that, when you want to value a business using price earning ratio, it is only a listed company. Only a listed company will have PE ratio. So if you now want to value an unlisted company or unquoted company, then you need to borrow the PE ratio of a comparable quoted company. However, you cannot use the PE ratio. You can't use the PE ratio of a listed company 100%. Let's say, for example, the PE ratio of a listed company is 10. So you cannot use this 10 to value an unquoted company, because when you do that, that means you are assuming that both the quoted company and the unquoted company, they have the same risk, which is not true. An unquoted company is more risky relative to a quoted company. Therefore, when you want to value a limited liability company using price earning ratio, you need to adjust the PE ratio of a comparable similar company. You need to adjust it downwardly between the ratio of 10 and 50. All right. So which means that if on the day of your exam, if the examiner did not tell you the percentage of adjustment, so it means that you are at liberty to either assume 12%, 10%, 15%, 18%, 20%, 30%, or 50%, whatever you think is the perceived risk associated with an unquoted company is what you are going to adjust for. Assume that, okay, this company, this limited liability company has a perceived risk of 15%. That means I'm supposed to account for 85% of the risk of the PE ratio. So whatever it is, you just have to state your assumption at the end of the day. You state your assumption in your calculation. So what we are saying in essence is that when you are valuing an unquoted company using price earning ratio, you need to borrow the PE ratio of a listed company, and the PE ratio of the listed company must be adjusted downwardly between the ratio of 10 and 50, depending on the perceived risk associated with the unquoted company. All right. However, the higher the risk associated with the unquoted company, the higher the percentage of adjustment. Okay. So, but on the day of your exam, if examiner wants you to have the same answer, you are going to be told that you should adjust the P ratio by a specific percentage. But where examiner is silent, that means it's open. So you are at liberty to adjust for the P ratio based on what you think is the perceived risk associated with an unquoted company. Okay, so again, you can read more. You can just go to the material and read more on all what I've summarized. They are there. Then, so like I said, when you want to determine the value of a business using the PE ratio, the market value of the business is computed as price earning ratio multiplied by earnings. This will be the total value. But if you want to determine value per share, it will be equal to price earning ratio multiplied by earnings per share. However, there's certainly going to be, you are going to make adjustments on your earnings because the earnings might have been distorted. Your earnings is based on accounting profit, okay, and accounting profit can be manipulated. So companies can carry out some kind of somersaulting accounting, or what you know as a window dressing or creative. The company can be creative in their earnings management and all of that to achieve a targeted goal. As a result of that, examiner will tell you that, okay, the company do this, and then the expenses, when you increase your expenses more than necessary, certainly that means you want to achieve a particular goal. So you need to make adjustments on your earnings, right? You make adjustment on your earnings. When you see live questions, we see some examples of that. So that's basically how to value a business using the price earning ratio. The next one is dividend yield. Now, what do you mean by dividend yield? Dividend yield is also known as cost of equity or rate of return on equity. I repeat, dividend yield is also known as cost of equity or rate of return on equity. The dividend yield is the ratio of dividend to share price, okay? Dividend yield is the ratio of dividend to share price because at times examiner may not give to you the dividend yield, okay? Of course, we have done this under cost of capital, cost of equity to be precise. So like I said, dividend yield is determined as dividend over share price, which is the same thing as cost of equity. Remember, when you are calculating cost of equity, this is the same formula that we use. Okay, if there is no growth, depending, if there is no growth, this is it. But if there's growth, then you need to adjust for growth. Okay, so that is for that. Then using dividend using dividend yield model or discounted dividend model, the value of a business represents the present value of future cash flows. The future cash flow is the dividend that the company will pay, all right, then discounted at the rate of return on equity or discounted at the dividend yield. Okay, now the value of a business using dividend yield can be calculated as follows, depending on whether dividend will remain constant or depending on whether dividend will grow, whether or not dividend will grow. So where dividend will not grow, the value of a business will be equal to dividend. Okay, it will be equal to dividend divided by dividend yield. Okay, divided by dividend yield or cost of equity. Okay, so this is the market value of a business where there is no growth. But where dividend will grow to perpetuity, where dividend will grow at a specific rate to perpetuity, then the value of a business, the market value of a business will be equal to dividend multiplied by 1 plus growth rate divided by the dividend yield minus the growth rate. This is the formula. You recall when we had cost of capital, You recall when we had cost of capital under cost of equity, we said that cost of equity is equal to current dividend, where there's growth, current dividend multiplied by 1 plus growth rate all over ex-div share price. Okay, ex-div share price plus growth rate, all of this multiplied by 100 over 1. You remember this formula. It's the same formula we are using for value. All we need to do is to just change this KE, which is the cost of equity, is the same thing as dividend yield. So this cost of equity will now become the denominator. The share price will now become the subject. Then the growth rate will come down to become a minus the cost of equity or dividend yield. That's what you have here. That's what you have here. So it's as simple as that. There's nothing there. We have done this in the past. Okay. So when you are valuing a business using dividend yield basis, all you need to do is to find the ratio of dividend to the dividend yield. And I said that if the dividend yield is not given to you, simply calculate cost of equity. Calculate cost of equity depending on whether dividend will grow or dividend will remain constant. So the dividend yield where there is no growth this is the formula. Dividend yield where there is growth will be computed as the dividend multiplied by 1 plus the growth rate divided by ex-div share price. Just put share price, then plus the growth rate, all multiplied by 100 over 1. So this is the formula. You're already familiar with this. Okay. And then, of course, the last one is the earnings yield. Okay. Earnings yield basis is the same thing. Earnings yield is similar to dividend yield. The only difference is just that you are changing dividend to earnings. What do you mean by earnings yield? Earnings yield represent the ratio of earnings to share price. Earnings yield represent the ratio of earnings to share price. That is, like I said, where there is no growth, earnings yield is equal to earnings divided by share price. Okay, multiplied by 100 over 1. So this is the formula for calculating earnings. So when you now want to determine the market value of the company using earnings yield, the market value represents the present value of future cash flows. The future cash flows is the earnings that the company will earn. So discounted at the rate of return of the company. Discounted at the rate of return of the company. Okay. Now, how do you then compute the market value of the business where there is growth in earnings? So where there is growth, then in this case, the market value, the value of the business will be computed as earnings multiplied by 1 plus the growth rate over earnings yield. Over earnings yield, you can denote it as R, then minus the growth rate. So this will give you the value of the business using earnings yield basis. All right. Again, if you want to calculate the earnings yield where there's growth, it will be earnings multiplied by 1 plus growth rate all over the share price plus the growth rate, all multiplied by 100 over 1. In case, if you are not given the earnings sheet, so you see the information to do that in the question. Okay then, so that is basically what you need to do under the income-based approach. The last method of valuation is the discounted cash flow-based approach, which is the most sophisticated method of valuation. Okay, the most sophisticated method of valuation is the discounted cash flow basis. So the discounted cash flow based approach relies heavily on the use of free cash flow. Okay, relies heavily on the use of free cash flow for the purpose of valuation. Now, what do you mean by free cash flow? Okay, what do you mean by free cash flow? Free cash flow is the cash flow available for distribution to the providers of capital, including the shareholders and then the debt holders, after considering all relevant expenses and capital expenditure. All right. When a company generates revenue, from the revenue, you need to deduct direct cost, okay, to have your gross profits. From the gross profits, you pay your operating cost, you deduct your operating cost. Then you have profit before interest and tax. You charge your tax, you have your profit before tax. Sorry, you charge your interest, you have your profit before tax. Then you charge your tax, you have your profit after tax. That profit after tax is the earnings of the business. So the profit before you arrive at the profit after tax, the profit has been distorted, the profit has been manipulated. So investors usually don't rely on accounting profit because the accounting profit can be manipulated. So free cash flow is more reliable. It's more because free cash flow is the real cash flow, is the real economic profit, is the real economic profit. So when you want to value a business, you are supposed to use the free cash flow basis. You are supposed to use the free cash flow. And this free cash flow will involve a whole lot of assumptions. That's why it is the most sophisticated method of valuation. And of course, it will require more effort. Okay, it will require more effort. Now, when you talk about, like I said, when you talk about free cash flow, is the cash flow available for distribution to the providers of capital, including the shareholders and then the debt holders, after considering all relevant outgoings, all relevant expenses, and then the capital expenditure. Okay, the capital expenditure to keep the operation going. Right. So the cash that is available, of course, will be distributed to the providers of capital. Now, there are basically two types of free cash flow. There are two types of free cash flow. Let me see if we have it in this material. We have free cash flow to the firm and then free cash flow to equity. Okay, let me just help you put it somewhere here. All right. So like I said, there are two types of free cash flow. Let me put it types of free cash flow. Types of free cash flow. So basically, there are two types of free cash flow. One is free cash flow to the firm. Free cash flow to the firm. That is FCFF. So the free cash flow to the firm represent the cash flow available for distribution to shareholders and then the debt holders. This represents the cash flow available for distribution to equity holders and debt holders. And it is used, the free cash flow to the firm is used for determining or for valuing or for determining, it's used for determining, let me put it that way. It is used for determining corporate value, corporate or enterprise value. Okay, when you want to determine the value of a company, you use free cash flow to the firm. And this free cash flow is available for distribution to both equity holders and debt holders. Equity holder is the same thing as shareholders. All right. Now, I've been talking since. I've not heard from any one of you. Are you guys still with me?
Yes, sir.
Yes, sir.
Okay.
Yes, sir.
So that gives me an assurance that you are still you are with me. I just want to be sure that I'm not talking inside baskets. All right. Then the second one, number 2, is the free cash flow to equity. Free cash flow to equity. FCFE. Free cash flow to equity. Now, the free cash flow to equity, let me put it down. This is the cash flow available for distribution to equity holders. Okay? It is used for calculating equity value. It is used for determining or calculating equity value. So when you want to determine the market value of equity, you can use free cash flow to equity to do that. Now, before we talk about the uses of free cash flow, what are the methods? What are the formats? How do you calculate free cash flow to the firm? You can call it free cash flow to the firm or free cash flow to company, FCFC or FCFF. Whether you call it free cash flow to the firm or free cash flow to the company is the same thing. Now, how do you compute? How do you compute free cash flow to the firm? There are 2 different formats. Let me see. How many of them do you have in this material? So you have only one. So I can give you additional one. So the formats you are going to use to calculate your free cash flow will depend on the information available in the question. So if in the question you are given information on profit before interest and tax, remember, we said that free cash flow to the firm is the cash flow available for distribution to providers of capital. Anything that relates to shareholders and debt holders, you have to ignore it. That is, anything like dividend, anything like interest expense, loan repayments, proceeds from debt issued, so you ignore them when you are calculating free cash flow to the firm, because this free cash flow to the firm is the totality of your free cash flow. So it is meant for distribution to providers of capital. So when you now want to calculate your free cash flow to the firm, if in the question you are given profit before interest and tax, so you are starting from profit before interest and tax. So the next thing you are going to do, ordinarily in your income statement, after profit before interest and tax, you need to charge interest expense, right? But you are not going to consider interest because that interest is meant for debt holders. So you don't consider anything that relates to the debt holders or that relates to the providers of capital. So you ignore interest. So immediately after your profit before interest and tax, the next thing you are going to do is to charge tax. How do you calculate your tax? Your tax will be computed on the profit before interest and tax multiplied by company tax rates. So you multiply company tax rate on the profit before interest and tax. Whatever you have, you deduct your tax. So there is no need for you to be finding difference. You don't need to find difference. Just put minus the value. So leave it at that. The next thing you are going to do after that is to consider non-cash item like depreciation, amortization, provisions, anything that does not involve movement of cash, okay, that you have deducted already before arriving at profit before interest and tax. Then in arriving at your profit before interest, and you need to add it back. So you add back non-cash item. Again, after non-cash item, you need to consider changes in working capital, okay? You consider changes in working capital. If your working capital increases, Okay, if your working capital increases, that's a cash outflow. So you need to put it in brackets. It's a cash outflow. I believe you guys have done IS 7, okay, statement of cash flow. So your lecturer might have told you that. So when your working capital, especially if you are given to if you are given financial information for 2 periods, if you are given financial information for 2 periods, so you need to check out for working capital movement. All right, you want to know whether there's a change in working capital. So if your working capital increases, that means you have spent more money. Cash has gone out. Therefore, you put it in brackets. Okay. But if your working capital reduces, that means cash has come in. So it's a positive. How do you know? What do you mean by this? Let's say, for example, we have 2023. We also have 2024. Let me look for a bigger space so that I don't manage. Okay, let me just. Now, let's say now you want to determine the change between the 2 years. Let's say you have inventory, for example, let me call it stock because of space. Let's say you have inventory in 2023 as 500. In 2024, your inventory has increased to 700. Between the 2 years, what is the change? Before, your inventory is 500. Now it has increased to 700 by 200. That means you have spent additional money to purchase inventory. More cash has been spent to purchase inventory. Therefore, this 200 is an increase in cash flow. You put it in brackets. Let's say also you have accounts receivable. So you have receivables. In 2023, you have receivable of 200, right? Then in 2024, let's say you have receivable of 150. So you can see your receivable has reduced by 50. That 50 is a plus. That means cash has come in. Let's say these are the two items you have under your current assets. So in this case, I need to get the total change. The difference between 250 will be minus 150. That means we have additional working capital. That means our working capital has increased by 150. Therefore, in place, that would be increase in working capital. So if the working capital has reduced, of course, it will be a decrease in working capital. So this is how you are going to check for movement in working capital. Whatever it is, you come and post. Then, after changes in working capital, you also need to consider capital expenditure. You want to know if the company has purchased additional non-current assets. Again, there's a format you can use to do this. But again, when we have illustration, I will use a particular question to demonstrate that. Okay, so if you have capital expenditure, it's a cash outflow, then you put it in brackets. So the difference between everything is we give you the free cash flow to the firm. That's the free cash flow. This is one way of calculating free cash flow and I want us to solve a question tonight too. It's almost time. Anyway, let's move on. Now, the other method is that if, in this one, we are starting from profit before interest and tax. It is possible in the question, you may not be given profit before interest and tax. Examiner can give you profit after tax. So if you are given profit after tax, then how do you compute? How do you compute free cash flow to the firm? Let me see if I can have a space here. No. Maybe I should just use, okay, let's see. Maybe I should use the working notes to show you that one. Let me see. Wow. See how time flies. Okay. Let me stop sharing this. Let me switch to the working notes. Wherever we stop, we continue next time. By the grace of God. So like I said, your free cash flow to the firm FCFF can be determined starting from profit after tax. I just showed you, we started with profit before interest and tax. What if in the question you are not given profit before interest and tax, you are given profit after tax? Therefore, when you want to calculate the free cash flow to the firm, starting from profit before interest and tax, so you just go to your income statement, bring out the profit after tax. Now, remember, before arriving at this profit after tax, you have deducted interest expense, you have paid tax, you have charged, you have deducted non-cash item, depreciation, amortization, provision on doubtful debt, and all of that. So, all those adjustments, all those deductions that you have made, you need to return it. First thing first, in this profit, before arriving at the profit after tax, you have deducted interest. Therefore, you need to add back the net interest expense. How do you do this? Just pick the interest, the value of the interest, then you multiply 1 minus tax. So that will give you the net interest. So you add it back, you return it. Again, before arriving at the profit after tax, you have deducted depreciation, which is a non-cash item. Anything like depreciation, non-cash item like depreciation, all right, amortization, provisions, they are non-cash item. So you return it, right? Then you need to consider capital expenditure, changes in working capital. So if your working capital increases, changes in working capital. So if your working capital reduces, if your working capital decreases, that's a plus. If your working capital increases, that's a minus. Then you consider capital expenditure. Okay, so this is the cash outflow. Then the difference will give you the free cash flow to the firm. This is the free cash flow to the firm. So this is another method or another format for calculating free cash flow to the firm. Quickly, let me show you how to calculate free cash flow to equity. So calculating free cash flow to equity. FCFE. Remember, we said that free cash flow to equity represent the cash flow available for distribution to equity holders, and it is used mainly for determining equity value. Okay, so when you want to calculate the value, you want to determine free cash flow to equity. If in the question you are given profit before interest and tax, or don't let me start from here. There are three formats I will give to you. If in the question you are given free cash flow to the firm, you are given free cash flow to the firm and you are asked to calculate free cash flow to equity. So in this case, remember, from this free cash flow to the firm, we said the free cash flow to the firm is the cash flow available for distribution to providers of capital. You need to settle debt holders first. So you pay interest. If there's any loan repayments, you have borrowed loan and you want to pay the loan, so cash is going out, you consider that. If it is possible, the company might have borrowed another entity a loan and the entity are paying back. Then that's proceed from debt issue. Whatever the case may be, from this free cash flow to the firm, you need to pay interest. This should be net interest. All right, which is interest multiplied by 1 minus tax rate. So it's a deduction. You are paying it. Then there may be loan repayments. part of the loan that the company has borrowed, maybe the company is paying back. When you are paying loan, cash is going out. Okay? Then you also need to consider proceed from debt issued. Like I said, it is possible that the company has loaned out has loaned money to some entity, and those entities are now paying back the loan. So that's a proceed from debt issued. So it's a plus. When you add it up, that will give you free cash flow to equity. So this is one format of calculating free cash flow to equity. The second one is to calculate your free cash flow to, let me see if this space will be sufficient. Let's manage. So free cash flow to equity, FCFE. So if you want to start from the beginning, you want to calculate free cash flow to equity, starting from profit before interest and tax. Okay, so this is the format. It is possible in a question examiner may want you to calculate free cash flow to equity, and you are not given profit after tax, but you are given profit before interest and tax. Therefore, you pick the profits before interest and tax as given to you, put it there. Then from this, you pay interest. So it's a deduction. No need to look for after tax, just deduct the interest. Then you are going to have profit before tax. From the profit before tax, you pay tax, which will be profit before tax multiplied by company tax rates. So that will give you the tax. Then from this, you add back the non-cash item, depreciation, amortization, or provision. So you add it back. Then you consider changes in working capital. Consider changes in working capital. So if your working capital decreases, you put it's a plus. If it increases, it's a minus. Then you consider capital expenditure. It's a cash outflow. Then you consider if there's any loan repayments. If there's loan repayments, so it's a cash outflow. Then you consider if there's proceed from debt issued, it's a plus. So you consider proceed from debt issued, it's a plus. When you add up everything, it will give you free cash flow to equity. So this another format of calculating free cash flow to equity. The last one, the last format is if in the question you are given profit after tax. If you are given profit after tax, then I can say you can calculate your free cash flow. Let me write it. The free cash flow to equity, this one is to starting from profit after tax. So if you are given profit after tax in the question, that's your starting point. In this case, you then say profit after tax as given to you, then you add back non-cash item like depreciation, amortization, or provisions, which you have initially deducted to arrive at the profit after tax. So you add it back. Then you consider changes in working capital. Any decrease is a plus. Any increase in working capital is a minus. Then you consider capital expenditure. It's a cash outflow. You consider any loan repayments, loan or debt repayments. It's a cash outflow. Then you consider any proceed from debt issued. Okay, it's a plus. Then you have your free cash flow to equity. So these are the relevant formats that you can use to calculate free cash flow to the firm and then free cash flow to equity. The last area we are going to talk about is are the uses. What do you understand? What are the uses of free cash flow? Okay, uses of free cash flow. Of course, free cash flow can be used for one, let me put it down, free cash flow can be used for 1.1, paying debts. You can pay debt from the free cash flow, okay? Paying debts, okay? 2, growth and expansion. You can use free cash flow for growth and expansion because it's free. Instead of borrowing money and be paying interest, you can use your free cash flow to do that, to fund your expansion activity. Then number 3, you can use free cash flow for the purpose of merger and acquisition or business combination. Okay, you can use the free cash flow to fund the merger and acquisition transaction. Then number 4, paying dividend. You can use free cash flow to pay dividend to the shareholders. Then number 5, you can use it to determine dividend capacity. Dividend capacity. Notes, dividend capacity, let me put it down for you. Dividend capacity is the ability of a company to pay dividend from the cash flow available for distribution to equity holders. Dividend capacity represents the ability of a company, let me write this, represents the ability of a company to pay dividend from the cash flow available for distribution to equity holders. Okay, so it is computed as follows. Dividend capacity. Dividend capacity is calculated as free cash flow to equity over dividend. So it is measured in times, just like you have interest cover. So dividend capacity is the ratio of free cash flow to equity to dividend. All right. So that is basically that. These are some of the uses of free cash flow. Okay. Now, what else? You see, when you are valuing a business using discounted cash flow basis, There are different scenarios, especially if it has to do with merger and acquisition or business combination. There are three different scenarios that may arise, but I don't think ICAN will be asking you that kind of it's more technical. I don't think ICAN can be asking you at this level. When you get to professional level, yes. But again, that notwithstanding, let me stop sharing this and move to the other. Uh, so again, you never can tell, but it's good to know. So you can just go to the material to read about all these scenarios. Okay, you can read about the scenario when you have business combination transaction, you want to value a business through business combination arising from merger and acquisition. There are three different scenarios that could arise. Scenario one, we have scenario two, and then scenario three. The scenario one will occur when business and financial risk are expected to change as a result of the business combination. When business and financial risk will change as a result of the business combination. So that means it is scenario one. Business risk and financial risk will change. So we say this is scenario one. So when this happens, the free cash flow to the firm should be discounted using the WACC of the combined businesses. You use the WACC of the combined businesses to discount the free cash flow to the firm that you have calculated. All right. So of course, you remember when we had project-specific cost of capital, when we had WACC of the combined activities, the same way you normally calculate WACC of the combined activity is the same way you are going to calculate WACC of the combined businesses. These are the procedures here, all right? So just go through it. Then, of course, like I said, there will always be two stages for your valuation. We can't do calculation again today. It's almost time. So let me just take my time to finish the explanation so that in our next class, we do purely calculations. We do purely calculations. So now, when you don't want to value the business under the first scenario, first thing first, you need to calculate your free cash flow to the firm. Then after that, you then go and calculate your WACC. Your WACC is the WACC, weighted average cost of capital of combined businesses. That's your WACC. Instead of WACC, it will be WACC. So the same format, the same procedure for calculating WACC is the same thing you are going to use to calculate your WACC. That is, you are going to identify the beta of each business, of individual business. You ungear the beta if it is geared. Then step 3, you calculate market value of equity and debt of individual company. Then that will represent the pre-acquisition or pre-merger market value. Then step 4, you calculate the weighted average asset beta or weighted average beta of the combined businesses using this formula. You already know this formula. We've done it before. Then step 5, you regear. Then steps to incorporate the financial risk after the business combination. Then step 6, you calculate cost of equity using capping. Then step 7, you calculate the WACC, weighted average cost of capital of the combined businesses. Okay, so that is what you need to do. After you have calculated the WACC, then step 3 is to then determine the present value. Determine the present value for the initial period. You determine present value for the initial period, then you determine present value after the initial period. Okay, so to calculate the PV, I will show you the formula you are going to use to calculate PV after the initial period later on. All right, then for scenario 2, scenario 2 will arise where business risk will not change. Okay, business risk will not change, but financial risk will change as a result of the business combination. So when this happens, you are supposed to use adjusted present value to value the business. All right. When business risk will not change, but financial risk will change as a result of the business combination, the valuation should be done using the adjusted present value. So how do you calculate adjusted present value? Same way, there are three steps. The first step is to calculate base case NPV. Then step 2, you calculate present value of financing effect. Then step 3 is to calculate the adjusted present value. The adjusted present value is the total value, which represents the corporate value or enterprise value. All right. So that's all you need to do. How do you then calculate base case NPV? As a refresher, to calculate your base case NPV, first thing first, you need to calculate free cash flow to the firm. When you calculate the free cash flow to the firm, step 2, you calculate cost of equity on gear. The cost of equity on gear will depend on whether you are given a beta value or you are given cost of equity or WACC. All right, whatever the case may be, you already know how to do this. Just calculate cost of equity on gear. Then step 3, you calculate present value for the initial period. You calculate present value for the initial period. Then step 3, you calculate PV after the initial period. You have your total present value. Then you now deduct the purchase consideration. You deduct purchase consideration. So that will give you, this is the formats we are going to use. This is the formats where there is no growth. This is present value to infinity after the initial period. Where there is growth, this is the format to use. So you already have it there. So I don't need to give it to you again. Maybe when we have illustration, I can demonstrate that for you to see. All right. Again, like I said, this is purely strategic financial management. I doubt ICAN can be asking all of this. It should be ahead. I mean, it should be higher. This is more than your capacity. ICAN should not be testing this at this level. All right. In any case, so to get your base case NPV, it should be the total present value minus purchase consideration. All right. So you keep it on one side. You then go ahead and calculate the present value of financing effect cash flow. So you go to the question, am I given issue costs? Do you have subsidized loan? Is there anything like interest? Whatever it is, go and calculate PV of issue cost, calculate PV of tax saved on interest, calculate PV of net subsidy. Then you have your PV of financing effect. So you then calculate the adjusted present value, which is the base case NPV plus minus PV of financing effect. So that's all you need to do. Then after that, examiner may want you to determine equity value, post-acquisition or post-merger equity value. The post-acquisition equity value will represent the difference between the corporate value or enterprise value minus the debt value. Okay, the difference between corporate value and debt value will give you post-merger or post-acquisition equity value. Okay, so that is that. Then examiner can ask you to advise if the acquisition should be considered. The acquisition will be considered if it will result to synergy being created or additional equity value being created. So that's what you need to do under scenario 2. Then for scenario 3 will arise whereby business risk and financial risk will not change. Okay. Business and financial risk will not change. So when this happens, the valuation should be, your free cash flow should be discounted using the current WACC. Okay, you are going to use the current WACC of the combined companies. That's all you need to do. It's the most straightforward of evaluation. Okay, so these are the scenarios that you need to consider. Like I said, all these scenarios are particularly possible if it is if the transaction has to do with merger and acquisition, if it is for business combination. So all those scenarios that I mentioned, one of them will occur. Okay. So again, how do you identify whether business risk will change and financial risk will change? So business risk will change if the two businesses are not in the same industry. Remember, business risk is the risk associated with the industry where a company operates. So where the two companies are in different industry, that means business risk will change. Okay. Then financial risk, or examiner can tell you that, okay, let me just, okay. For the last, this will be the last thing we are going to talk about this. So that in our next class, we just do calculation. Notes, business risk. Will change if the two companies are not in the same industry. So this is one way, this is one indication. Once you go to the question and you notice that there is an indication that the two of them are not in the same industry, that means business risk will change. Or if you are given, or if, let me put it this way, or if different asset beta. Another way to know whether business risk will change is if you are given different asset beta. Remember, asset beta measures only business risk. So if you are given different asset beta, it means that the business risk will change. Given. Okay, so these are the ways that you can know whether business risk will change. Then financial risk. Will change. Financial risk will change if the business combination will result to additional debt being paid. Will change if the business combination will result in additional debts being paid. So, or where debt equity proportion, that is gearing ratio, debt equity proportion after the business combination will change. Okay, so if you are told in the question that after the business combination, there will be need to pay debts, in that case, financial risk will change. If you are not told that, examiner can tell you that the debt equity ratio after the business combination will change. So when you are given different debt equity ratio or gearing ratio, it means that the financial risk will change. So these are the indication, these are the things you need to look out for in the question to know whether business and the financial risk will change. And yeah, so these are all the relevant concepts that you need to know. Let me know if you have any question for me, so that some of you have disappeared. No worry, it's understandable. Yes, let me know if you have any question for me. So this is what we are going to call it today. When next we meet by the grace of God, we'll be rounding up. So if I'm able to solve 2, 3 different or 4 different illustrations, then that means we are good. We are good. Okay. So let me know, please. Any question? If there's none, we close the class. Okay. I still have Adele is still on. Angela is on. David, Esther, Ruth, Glory, Ahmed, Omkie. Yes, Joy, Ogechi, Oreoluwa, Samiat. Some of you have disappeared. That's okay. Yes, thank you guys for your time and patience. We are going to meet by the grace of God on Tuesday, when we shall continue with the valuation. All right. Good night, everyone. All right.
Good night, sir. Thank you, sir.
You're welcome. Yeah, good
Thank you,
night.
sir.
You're welcome. Yeah, good night.